Today we are talking about my top 7 stocks to buy in February 2022. Just to be clear, I don't own every single stock I talk about in this video, but I do own most. I will be investing more money into these in the next few weeks depending on how everything goes. The markets overall are down right now.
As we've reported, it was a wild ride.
Worst week since the pandemic crash.
I'm looking at the chart here. It doesn't look good.
It might especially be a great time to buy these if they are the right fit for you. I do see a lot of potential here though in general, and I'll show you a breakdown of what these stocks are and why I picked them, but this won't be like a crazy analytical video, right? Like I'm not going to get super deep into the numbers, and I'll mostly just give my reasoning behind them, so it'll be very easy and simple to follow along even if you're a beginner. Number 1 is Charles Schwab. Financial stocks can do really well in an environment of rising interest rates and high liquidity, right? Because banks can earn even more on their lending products. So for example, on mortgages, on car loans, right? And not to mention all the trading fees due to everyone cashing out in the markets that these banks can charge, right? So one bank that has done really well is of course Charles Schwab, which is involved in both of these services as well as wealth management. Schwab shares are overall up in the past few months for these reasons, and I think they will go up even more as the markets recover. Many of the top players in the industry think that Schwab is a top pick because of its balanced focus on organic growth, client service, and merger integration. A lot of these people also see gains of up to 40% on the share, while analysts expect a 10% return. Overall, Schwab's revenues have increased by over 80% in 2021, and I think this year it'll be the same, so I am very bullish on this stock. Number 2 is Disney. So you come home, you sit on the couch.
Do we dare?
We dare.
You grab the remote control. What are you gonna watch? If you're into sports, you'll be watching Disney's ESPN, right? If you're looking for a hot trending show, the Book of Boba Fett reached 1.7 million viewers with its premiere last week on Disney+. If you want to watch one of the last year's biggest box office winners, it's a good time to point out that Disney actually owns Marvel, right? And Marvel characters scored the highest grossing films of 2021 in America. Disney is not even a brand, it's a lifestyle. Like everyone's childhood had Disney in it in some sort of way. They have been around for many decades and continue to show strong growth. Diversification has been key. With Disney, they own a variety of platforms and companies that continue to bring in revenues outside of its core business. They own Marvel, right? Star Wars, Pixar, and more. And I almost forgot Disney Plus. Disney Plus is its streaming service that provides exclusive content for its subscribers. The numbers for that have grown extremely fast, and it now has over 146 million paid subscribers. In its first quarter alone, it was able to attract 95 million paying customers, and that's huge.
Yo, that's big.
Disney Plus intends to branch out into the international markets such as Hong Kong and Eastern Europe, and long-term goals include reaching 230 to 260 million subscribers by 2024. Disney also has the world's most visited theme parks, right? And it will expand its cruise ship fleet by 25% in a few months. As complete as Disney is as an entertainment empire, it's still surprising to see the stock dip so low here, but then again, the markets in general are down. I think it will recover, and this dip might be a great time to buy it at a discount. A huge company like Disney that has been innovating for years is not going anywhere anytime soon, so now is a great time to get in. Number 3 is Adobe. When you think of big tech, you might think of companies like Apple, Microsoft, Google, and Meta platforms, right? Maybe even Tesla. Those businesses are definitely on a very high level. However, right below that tier are sub 300 billion market cap businesses like Salesforce, Oracle, Intel, right? Shopify. All very well-known companies, but you may be surprised to learn that Adobe is more valuable than any company on that list, even though Adobe's stock price is down around 25% from its all-time high as I'm recording this video. And Adobe is the industry leader in digital media software for individuals, students, and businesses of all sizes. Adobe is also one of the pioneers of software as a service. In 2013, Adobe converted its business from selling software that people could download to a recurring revenue stream through Adobe Creative Cloud, a subscription that gives access to the whole Adobe suite of products for a monthly or annual fee. Since then, Adobe has become one of the most stable software companies in the world. Its revenue growth may have slowed down, but its profit and free cash flow continue to improve greatly. In short, Adobe is an incredible business that generates subscription revenue, has moderate growth, and is bringing in a lot of profit. Especially a great buy right now since it's on a big discount. Number 4 is PayPal. PayPal is a great choice for investors interested in the financial sector, but that don't want to invest in a traditional bank like JP Morgan or Bank of America, right? PayPal is a leader in peer-to-peer payments. They support small and mid-sized businesses, right? Like a lot of self-employed people as well in the gig economy. It's also big in e-commerce payments, so it has a strong business in place in a lot of these sectors. PayPal is constantly innovating, and that's why their revenue and cash flow have consistently increased over the past few years. They support crypto trading now and have a buy now pay later option as well, which has only helped their phenomenal growth. Their revenue has quadrupled from 5 billion to 21 billion in less than 10 years since 2012. PayPal could grow a lot from here with everything they have going on for them. Oh, and did I mention they own Venmo and Honey? So with the stock price down over 40% from its 52-week high, hovering around a 52-week low, PayPal is just too strong of a business to ignore right now. A lot of potential here even after the recovery, right? So I am highly bullish on this stock. Before we move on to number 5, this is just a quick reminder to smash that like button. Thank you so much. Number 5 is one of my top metaverse stocks, Roblox. The metaverse has been unquestionably the hottest stock market topic in recent months. Roblox is a platform that brings players and developers together. Alright, the company's mission is to enable billions of people from across the globe to have fun, learn, and play. And it's built on a strong foundation of millions of developers who produce these awesome immersive experiences using the Roblox studio. What Roblox is doing is giving businesses the option of creating their own virtual experience that is tailored to their specific needs. To understand its business model, imagine it as a company with a framework like YouTube, right? Where third parties upload their own videos and are paid based on the traffic that the videos receive. Similarly, Roblox allows users to create their own games, and they are compensated when users play them or spend money on services related to the game. Outside developers are constantly building new games and content to integrate into the existing game, so it's still growing and there's a lot of opportunity. Based on the average monthly visits and time spent playing, Roblox is ranked as a top entertainment platform for those 18 and under. But with that said, Roblox is making a push to attract older audiences as well. Microsoft acquired Roblox a couple years back, and it's very attractive at a 50% discount right now, right? At a price of $63 at the time of this recording. Number 6 is Nvidia. Semiconductors are like the new oil, right? Nvidia has been a leader in the sector, but will its growth continue? I think so. I mean, the company is firing on all cylinders, right? And if you really look under the hood and see what they're doing, you'll see how bright their future looks. Nvidia is involved in nearly every industry possible, right? Cloud computing, video games, cybersecurity, electric vehicles, hell, even space exploration. I won't even get started with how important of a hardware player they will be in the metaverse. They have great margins and they have a massive market share in the GPU space alone. Even with the markets down right now, the stock price has delivered over a 50,000% return since going public in 1999. A $10,000 investment then would be worth around $4 to $5 million today. Nvidia's share price has had a very strong 52-week high of $346, and the company has a strong balance sheet with $19.3 billion in cash and $11.8 billion in debt. All things considered, it's difficult to not consider buying Nvidia at its current discount. Number 7 is Amazon. They sell everything, literally everything. Okay, Amazon has changed everyone's lives and just made it easier. They have solved so many problems, and that is why Amazon is the world's largest e-commerce company. During the pandemic, Amazon could safely deliver all the necessities needed to your doorstep, right? Such as groceries, or anything else that you might need. Meeting increased COVID-19 related demands allowed them to grow much faster than people thought. If COVID couldn't bring them down, like nothing will bring them down.
She's not gonna break me down, that's for sure.
Okay, except maybe the government with their antitrust laws. And the thing is, they don't just sell things online, they also focus on other types of businesses and markets, such as in cloud computing, artificial intelligence, and digital streaming. Okay, so now for the bad news. That's happened in these past few months. In the recent quarter, Amazon did underperform and didn't hit earnings that were expected. Amazon CEO Andy Jassy, I think that's how you say his name, discussed on the recent earnings call that he expects several $billion of additional costs for the fourth quarter related to higher employee costs, supply chain, labor shortages, and overall increased cost of goods sold. Even though Amazon had a rough last quarter, it still did much better than many of its competitors. So I think the stock will make a big comeback here on out because of all the potential it has and because of Amazon Web Services, which is predicted to grow for at least the next 7 years with double-digit gain. Okay, there's also Amazon Marketplace, right? Artificial intelligence, digital streaming, and a lot more. And performance like this isn't new for Amazon. They've seen a lot of big dips in their stocks, but in the long term, they have provided massive gains, and the stock is on a big discount right now, so I highly recommend checking it out. Also, y'all, I'm just some guy on the internet. Always
do your research.
Okay, this is not financial advice, and only invest in companies you believe in, because there will be lots of ups and downs with these stocks. You don't want to buy into a company you don't believe in and then get scared over a dip and end up selling at a loss, right? So just always do your research. If you found this video helpful, make sure to hit that subscribe button and the bell besides it, because I post new videos every week. And if you want, go get up to $250 in free Bitcoin with my BlockFi link down below. Lastly, if you want to start investing in stocks, I made a special limited time deal with Webull for you also. Go get 3 to 4 free stocks with them by signing up with my link down below as well.
And I'm so excited.
Thank you so much for watching, and I'll see you next week.